You ever stop and wonder how a massive company decides to, say, build a factory on the other side of the planet? We're talking about decisions worth hundreds of millions, sometimes billions of dollars. It is one of the highest stakes games in the entire world of business, and today we are going to pull back the curtain and see exactly how it's played.
So let's get right into it. How do they really make these billion-dollar bets? Is it just some CEO's gut feeling, a roll of the dice? No, not at all. There is a rigorous and honestly a fascinating science behind it all. It's a framework for trying to peer into the future and place a bet with the best possible odds.
And it all starts with two really fundamental concepts. You could call them the twin forces that govern every single investment ever made, from you buying one share of a stock to a company building a global empire. Let's just call them the basic rules of the game.
First up, you've got return. Pretty simple, right? This is the prize. It's the potential profit you stand to make. Now, the finance pros have this special way of calculating it all down to a single number, a score, really, to judge a project. If it's positive, that's good. Negative? Bad. It's the number you're chasing.
But you can't talk about the prize without talking about the peril, and that's risk. Now, what's really interesting here is that in finance, risk isn't just about losing money. It's about uncertainty. It's the chance that reality won't quite match your forecast, for better or for worse. It's the wobble, the unpredictability of it all.
And this brings us to probably the most famous relationship in all of finance, the risk-return trade-off. It's simple, it's elegant, and you just can't escape it. If you want a shot at a massive return, well, you have to accept a massive amount of uncertainty. If you want safety and predictability, you got to be content with a smaller price. They are two sides of the very same coin.
Okay, so this isn't just theory, right? Companies don't just talk about these ideas. They actually try to pin a number on them. They try to quantify the future. And yeah, it sounds kind of impossible, but they have some pretty clever tools to get it done. Let's take a look at one.
So here's how they do it. This is called probability analysis. Instead of making just one single guess about the future, you imagine a few different versions. So for this project, there's an optimistic future where you make £6,000, a likely one where you make $3,000, and a pessimistic one where you actually lose $4,000. And here's the key part. You assign a probability to each one.
All right, so you take those possible futures, you weigh them by how likely they are to happen, you blend them all together, and you get this, £2,500. That's your expected return. Now, it's not a guarantee, of course, but it is the statistically most likely outcome of this bet.
But what about the risk? Well, that gets a number too, £3,500. And this figure, this is a number for that wobble we talked about, the spread of all the possible outcomes. A bigger number here means the results could be all over the map. That means higher risk. A smaller number? That means the outcomes are all bunched together, a much safer, more predictable bet. Okay, so that's the basic toolkit. But what happens when that project isn't, in your own backyard? What happens when your money has to cross oceans, time zones, and currencies? Well, that's when the complexity just explodes. Suddenly, you're not just forecasting your own market anymore. Now you have to worry about volatile exchange rates that can literally wipe out your profits overnight. You've got to navigate this labyrinth of international tax laws. You even have to adjust for the fundamental risk of doing business in a different country. It is a whole new ballgame.
I mean, take exchange rates. You can't just guess. You can't just throw a dart at a board. Companies use these complex economic models to forecast how currencies might move against each other years into the future. You can see here, they have to project a very specific rate for each and every year of the project. Every single number is a critical piece of the puzzle.
So now, let's see how this all comes together in the real world. We're going to walk through a case study where every single piece we've just talked about, return, risk, exchange rates, and especially tax, all comes together to make or break a huge decision. This is where the rubber meets the road. So here's the setup. We've got a company in the UK, and it's looking at a project in the United States. They've run all the numbers, but the final call, the go or no-go, is going to pivot on a single, and let's be honest, a seemingly boring little detail of international law, something called a double tax treaty.
And this just brilliantly illustrates the stakes. If a tax treaty exists between the UK and the US, the company only has to pay tax at the higher of the two countries' rates, which works out to be 20%. But if there's no treaty, they get taxed by both countries, adding up to a punishing 35%. This one rule changes absolutely everything. So, let's run the numbers. Scenario 1, the tax treaty is in place. The company pays that lower 20% tax rate.
When you factor that into the whole calculation, the final score, that net present value, is a positive £7,000. The verdict is clear. Green light. Accept the project. It creates value. But now, watch what happens when we just flip that one single switch. No treaty. The tax rate jumps to 35%. The exact same project, with the exact same sales and costs, suddenly has its profits just eaten away by taxes. The NPV plunges to a negative £11,000. The verdict is just as clear. You reject this project. It would literally destroy wealth.
Just look at that difference. That is an $18,000 swing on the project's value. The project goes from being a clear winner to an absolute loser, all because of one clause in an international agreement. This, right here, is why the finance folks obsess over the details. This is the billion-dollar decision in action.
So what's the big takeaway from all this? What's the bottom line? Well, it's that in the world of high-stakes finance, having a disciplined process is everything. And right at the heart of that process is one key metric.
Yeah, there are other ways to look at these things, but net present value, or NPV, is really considered the gold standard. And why is that? It's because it's the only one that considers everything: the timing of your profits, the risk involved, the sheer size of the project, and it rolls it all into one single number that directly answers the most important question: will this make our owners wealthier?
But, and this is a huge but, we have to remember what this is all built on. It's all built on forecasts, predictions. As this quote from the source material wisely points out, all of this is based on information that is inherently uncertain. We can calculate with incredible precision, but at the end of the day, we are precisely calculating a guess about the future.
Which leaves us with one final question to think about. We have the models, we have the formulas, we have the spreadsheets, we have all the science of financial appraisal. But at the end of the day, a human being still has to look at those numbers and make the final call. So where does that science end, and where does the art of judgment begin?